Disney is in certainly much more trouble than we knew about. They have been laying people off over the course of the last 10 months at a rate that we've never seen before. And in the most extreme case, which just happened today, at least according to Deadline and That Park Place, they've laid off hundreds more. Hundreds. This is something new for Disney and what is definitely a cost-cutting measure. And I think it shows us they're in a lot of trouble that they aren't telling anybody about. Let's dive into it. Here we go. Now, before we get started, just a quick reminder, I am on my way to 100K. I need your help to do that. I'd like to get that Christmas present this year before the end of December. So double check you're still subscribed to the channel. If this is your first time or your 1000th, you will get at least 1 to 2 items per day in the form of a video or a live stream on this channel, not to mention the expansion that is going to occur in other channels. So stay tuned. Oh, by the way, turn on the notification bell. And while you're at it, hit the thumbs up button because this one you're going to want to stick around for. First and foremost, we have this article coming from Marvin Montanaro based on the Deadline exclusive story from this morning. Disney hit with major layoffs as hundreds cut across film, TV, and finance. That seems like something that Disney has been doing quite regularly, especially news. That is what happened the last time around when they cut 200 people from, well, mostly the TV block and mostly the news. Let me tell you, Disney doesn't get the news right. They get the propaganda right, and nobody wants propaganda anymore. Disney needs to fix that. Let's scroll through the story, take a look at what Marvin has to say. The Walt Disney Company has initiated another significant wave of layoffs, impacting several hundred employees globally across multiple divisions, according to a new exclusive report from Deadline. The cuts are affecting key areas of Disney entertainment, including film and television marketing, TV publicity, casting, development, and even parts of the company's corporate financial operations, which isn't surprising to me. They've been managing those very poorly for a long period of time. The latest round marks the fourth wave of staff reductions in the past 10 months, and according to the report, it's the largest yet. While no full departments are being eliminated, although they should be, its scope of the cuts across film and television is described to be roughly equal. That's a lot. The majority of affected employees within Disney Entertainment Television are based in Los Angeles, and that makes a lot of sense since Disney is trying to get out of Burbank. They should have just moved forward with their Lake Nona project, but here we are, and they're always doing things the hard way these days. The restructuring is part of an ongoing cost-cutting initiative led by CEO Bob Iger, who returned to the helm of Disney in late 2022, much to the chagrin of people who liked the stock price where it was. And immediately, he pledged $7.5 billion in reductions across the company. That plan resulted in the elimination of 7,000 jobs in 2023. And believe it or not, some of those led to some lawsuits that Disney to this day is still dealing with. This newest wave is further evidence the company's aggressive streamlining strategy is far from over. And I have to tell you, that's also not surprising. Their earnings numbers are not going the right direction between film, television, and of course streaming. Those aren't pulling the weight that they need to at this stage of the game, and especially with Epic Universe down the street in Florida about to clean their clock as far as market share. I can't imagine losing 10% of market share if I'm Disney in Florida, let alone 20, and potentially 30 if that park continues to expand. Layoffs actually follow a supposedly strong earnings report, which I don't necessarily agree with. What's particularly notable is the latest development is the timing. Just the last month, Disney reported better than expected financial results in Q2, fueled primarily by its theme parks and sports divisions. Operating income in the direct-to-consumer streaming segment rose sharply, jumping $289 million year over year to $336 million, which makes sense when the league goes back into operation and our rights are still intact. At Disney's April shareholder meeting, Iger emphasized growth in the company's experiences division, particularly theme parks, claiming that new jobs were being created to support expansion and increased demand, which we all know is baloney sausage, especially after the things we're hearing today. That public optimism now appears to be in stark contrast to the reality that is behind the scenes and what many of us who've been analyzing Disney for a while were saying. This can't last, And it's smoke and mirrors at its finest under Bob Iger, who is the master at saying absolutely nothing while giving you 2 or 3 paragraphs of words. And Marvin says here, the very thing I led off with. This is a steady march of cuts. In March of 2025, they lost 200 employees, including members of ABC News and entertainment network teams like Freeform and FX. In October of 2024, a major restructuring shut down ABC's Signature, which was just garbage to begin with, folding its operations into 20th Television. About 30 employees there lost their jobs. And in July of 2024, approximately 140 workers were cut from Disney Entertainment Television, including 60 at National Geographic. And of these waves, and there have been many, many more than we've even illustrated here in this article or on this video, each wave has focused on streamlining Disney's traditional media operations, even as the company expands investments elsewhere. And I have a feeling we're going to start seeing cuts in the areas that they've expanded into, especially when it comes to promotion and propaganda. But I'm sure you already knew that. But Disney's not alone in what I would refer to as the new media era, something that they're not a part of. You see, Disney's layoffs arrive just as NBC Universal begins its own restructuring and spin-off of multiple cable networks into a new entity known as Versant. That's the new name for PMSNBC and other cable channels SpinCo that we've been talking about on this channel for quite some time. That move has also led to job losses as the broader media landscape continues to grapple with the fallout from declining cable viewership, a saturated streaming market, and a shifting audience behavior, which is frankly to ignore the old legacy media, especially the news. While some media conglomerates are consolidating to stay afloat, others are trimming legacy operations to fund future growth in theme parks, sports broadcasting, and international expansion. And I've got to tell you, they are the thoughtful ones. Of course, of those, the leader in the clubhouse is Comcast, as they seek to expand their theme park empire and finally actually get into the game competitively. That's bad news for Disney, since they really didn't have anybody gunning for them, including the folks down the street in both theme park locations in the US. And Marvin asks a relevant question. What's the road ahead? Well, with more cuts reportedly looming, questions are swirling about what Disney's long-term entertainment strategy truly looks like. I mean, after all, it certainly can't be Marvel in that particular framework, because it's failing faster than almost anything that Disney has had their hands into, including Star Wars, which is, well, a slower fall, but a guaranteed one. Despite strong performance in theme parks and incremental streaming gains, its core entertainment divisions continue to bear the brunt of restructuring efforts. Not to mention the fact that Disney proclaimed, perhaps all the way back in 2022, that streaming is dead. And if you listen to any one of your favorite creators here on YouTube, Rumble, Odyssey, Mindscatter, or X, we've been saying the same thing. Streaming is dead. It was a bad move to force all of your eggs into one basket when all your other baskets were fruitful, plentiful, and something that you could rely on. Streaming is a defiant teenager at best at this point and is likely to bring many media companies to their knees. Instead of taking Netflix's money and running to expand into other areas and to further develop the material that you could sell to them again and again, you decided to compete and operate in the same space with a withering catalog and grandiose ideas of premium television that you just didn't seem to have control of. And now, look what your bottom line is when it comes to these streaming services. A giant headache and a debt-generating princess that you can ill afford. And the question here, as our friend Marvin asks, whether this film strategy ultimately stabilizes the company or further fragments its identity remains to be seen. I'm going to tell you right now, fragmentation is just the order of the day for Bob Iger's Disney, which might as well be called the Iger Company at this point. Suffice it to say, I think this is an absolute disaster, but that's not the most relevant thing at this time. Your opinion is. Let me know what you think. Is Disney headed the right direction with these cuts? Are these something that we should have expected all along? Do you think that Disney is in a position to move forward with fewer people in a positive direction? Or do you suspect that this is just a way to reduce the expenses to the bottom line to make the stock look artificially more attractive? Let us know down in the comments section below if you have a thought on any one of those questions or one of your own. And as always, be sure to take care of yourself, take care of others, and until next time, see ya! But not at a Disney park.